Real estate tokenization platforms love bold promises. It's not uncommon to see marketing material boasting 11% to 17% ROI from rental income. The pitch is simple. Fractional property ownership via blockchain will give you passive income with better liquidity than traditional real estate. But ask any investor who has actually withdrawn those promised returns into their bank account, or a mainnet wallet like Ethereum or Binance Smart Chain, and a very different picture emerges. That double-digit ROI often melts into just 3%, 5% in reality. Why? Because hidden costs, conversion fees, gas charges, bridge transfers, and platform cuts eat away at the yield. This article examines exactly where the ROI leak happens, why platforms use low-fee blockchains for themselves, but leave investors with costly exits, and whether tokenized real estate is truly worth it. The promise of tokenized real estate ROI tokenization platforms advertise high returns based on gross rental yields of properties before expenses, fractional distribution of rent via tokens or stablecoins, liquidity pitch, sell anytime, low entry barrier compared to direct ownership. On paper, an investor buying into a tokenized apartment in the US or Europe might see an ROI projection of 11–17% annually. The number sounds attractive, especially compared to traditional rental yields of 6–8%. But as every blockchain investor knows, the devil is in the exit costs. The reality: ROI shrinks on the way out. Let's walk through what typically happens between rental income distribution and an investor finally receiving funds in their usable wallet or bank account. Platform fees. Many platforms charge maintenance fees, legal fees, and transaction fees before distributing income. These cuts already shave off 1–2% from the headline ROI, choice of blockchain. To save on their own transfer costs, platforms often issue tokens on low-fee blockchains like Gnosis, Tezos, or Polygon. While this reduces overhead for them, it forces investors to use bridges and conversions if they want to move funds to Ethereum, Binance Smart Chain, or cash out to exchanges. Bridge and conversion losses. Bridging stablecoins from low-fee chains to mainnets typically costs 0.3% to 1% per transfer, sometimes higher if liquidity is low. Converting from obscure stablecoins, platform native, to widely used ones like USDT or USDC can involve additional exchange spreads of 0.52%. Gas fees on mainnets Ethereum. Gas fees fluctuate but often eat $10, $50 per withdrawal, which is significant for small monthly rental distributions. Even on cheaper chains, repeated conversions accumulate. Bank or exchange withdrawals. Once tokens reach Binance, Coinbase, or another exchange, investors face withdrawal fees and fiat conversion charges, often 1–2%. Final net returns may fall by another 1–2%. A hypothetical ROI breakdown. Suppose a platform advertises 15% annual ROI on a $10,000 investment. Gross rental yield, $1,500, 15%. Platform fees, management legal, $150 bridge plus conversion fees, $200 gas fees, monthly transfers, $180, exchange, withdrawal to bank, $120, net ROI $850, 8.5%. But this is an optimistic scenario with low fees. In practice, with volatile gas costs and repeated conversions, that $1,500 often shrinks further. Realistic net ROI $300, $500, 3–5%, exactly the range many early investors report. Why platforms push low-fee chains? Tokenization companies often defend themselves by saying they're reducing costs by using cheaper blockchains. But the truth is, this decision primarily benefits the platform. They pay less to distribute rental income. They avoid the reputational risk of high Ethereum fees. They present themselves as efficient while pushing the real cost downstream. Meanwhile, investors are the ones left with friction, complexity, and expense when they try to move money into usable networks or fiat. The investor's trap: illusion versus reality. The problem here is not blockchain technology itself. In fact, blockchain does enable transparency, fractional ownership, and faster settlement, huge advantages over traditional real estate. The issue is the marketing spin. Platforms advertise gross ROI, not net ROI after withdrawals. They highlight passive income but gloss over the active management needed to bridge and convert funds. They use regulatory gray zones to avoid disclosing all the fee layers. The result: investors buy into an illusion of double-digit returns, only to experience single-digit disappointments. Is tokenized real estate worth it? The answer depends on the type of investor. Experienced crypto users may navigate fees efficiently, time gas costs, and use DeFi tricks to recover some returns. They might squeeze out 5–7% ROI. New retail investors, likely to get stuck with complex conversions and high costs, leaving them with only 3–5% ROI, barely better than a savings account. Long-term holders might benefit if property values appreciate significantly, but rental ROI alone is not the golden goose promised. Until platforms adopt clear disclosures, multi-chain liquidity solutions, and investor-friendly withdrawal paths, tokenized real estate remains a risky bet. Conclusion. When 15% ROI becomes 3%, it's not blockchain's fault, it's the result of hidden cuts and opaque marketing. Tokenization is a powerful innovation, but unless strict regulation, oversight, and investor protections are enforced, many projects will continue to operate as profit machines for platforms, not for investors. For now, tokenized real estate may not be a scam in every case, but it is definitely an ROI illusion that only a handful of savvy investors can navigate successfully.